One morning in March 1933, people in dozens of American towns walked up to their local bank and found the doors locked. Not "we'll be right back" locked, but bolted, shuttered, final. Their paychecks, their life savings, the cash they needed to buy food and pay rent were suddenly trapped behind a heavy steel door. There was no warning, no countdown, no chance to quietly move money out the day before. The place they had been told was the safest in town simply stopped existing for them. In a single night, 90 years later, depositors at Silicon Valley Bank learned the same lesson in a digital way. Their money did not disappear because a robber with a mask walked into the lobby. It disappeared because a group of people in a closed room looked at a balance sheet, admitted the hole was too big, and pressed a few keys on a keyboard. In both cases, ordinary people discovered something very uncomfortable. The number you see on a bank screen is not the same thing as having control over your own money. This video is not about predicting the next collapse or selling you fear. It is about something more practical and more uncomfortable. Every time banks fail, some people and some assets quietly survive almost untouched. In this video, I'm going to give you a clear, step-by-step checklist you can use to move part of your life to that side of the line. The protections I'll talk about are not secret strategies for millionaires or hedge funds. They are methods ordinary people have used again and again to get through banking panics with their freedom and their savings still intact. If you only pay attention during the loudest financial panics, it is easy to believe that banking crises are rare, one-off disasters. Something that happens once a generation, burns a few unlucky people, and then disappears. History tells a completely different story. Bank failures are more like earthquakes along the same fault line than like freak lightning strikes. The pressure builds out of sight for years, and then, over a few days or weeks, everything that looks solid begins to crack. In the early 1930s, more than 9,000 banks failed in the United States alone. In the late 1980s, the savings and loan crisis wiped out hundreds more and left taxpayers with a bill. In 2008, entire global banks vanished or had to be rescued in frantic weekend meetings. In 2013, depositors in Cyprus woke up to find that part of their savings had been turned into a tool to save the very banks they trusted. Different decades, different laws, different excuses. Underneath, the pattern is the same. Something promised to be safe suddenly isn't, and by the time most people realize it, their options are already gone. Instead of asking, will this happen again? A better question is, what actually survives when it does? Because when you look closely at past crises, you see something important. Time after time, through different countries and different banking systems, the same types of assets and the same types of decisions hold up better than others. If you understand that pattern, you don't have to guess the exact date of the next failure to start protecting yourself today. To see the pattern clearly, we have to go back to the most classic banking panic of all, the Great Depression. Imagine a small American town in 1932. There's one main street, one church, one general store, and one bank with a polished marble counter and a vault that everyone in town secretly admires. People bring their wages there on payday, sign a few forms, and walk out with a passbook that tells them their money is safe. The idea that the bank itself could be weaker than they are doesn't even occur to them. Then the rumors start. Someone hears that a bank to town's overclosed without warning. A neighbor says their cousin's savings disappeared when the doors shut. A local newspaper prints a cautious headline about liquidity problems and temporary measures, words that sound technical, but feel like a cold hand on the back of your neck. One morning, a few people decide to stand in line early, just in case. By noon, the line stretches around the block. By evening, the cash in the vault is gone. The next day, the doors don't open at all. When President Roosevelt called a nationwide bank holiday in 1933, the phrase sounded almost festive. In reality, it meant that millions of people simply could not reach their own deposits for days. If you ran a small store and kept a cash box at home, you could still drive to a wholesaler and buy inventory. If you owned a farm that produced food, you could still feed your family and barter with neighbors. If you quietly kept a stash of gold coins or silver in a place no banker knew about, you still had something other people wanted. But if everything you owned sat as numbers on a frozen ledger inside a locked building, you had nothing you could actually use. The lesson from that moment is cruelly simple. When banks fail, the balance of power shifts from people who own promises to people who control something real. A bank deposit is a promise from a bank to you. Cash in your hand, food in your cellar, tools in your workshop, or a piece of land that produces something are under your direct control. In a calm, orderly world, those estates feel almost the same. In a crisis, they are not the same at all. You might be tempted to think that was the 1930s. Things are different now. We have deposit insurance, central banks, and smartphone apps. So let's fast forward to 2008 and watch what happens when a modern financial system runs into the same old wall. This time, there are no long lines around the block, no crowds banging on heavy wooden doors. Most people interact with their bank through a glowing rectangle in their hand. Their paycheck arrives electronically, their bills are paid automatically, and everything feels frictionless and safe. Underneath that smooth surface, banks and investment firms are doing something very old, borrowing short, lending long, and hoping they can roll over their debts before anyone panics. They bundle mortgages into complex products, slice them into pieces, and sell them to each other. As long as housing prices rise and people keep making payments, the system looks stable. When prices fall and borrowers start to default, the losses are so tangled and so widespread that no one knows who is solvent and who is already quietly dead. When the panic hits, the language is different, but the feeling is the same. Credit lines are cut with little or no warning. Businesses that rely on short-term borrowing to fund payroll suddenly cannot roll their debt. People who counted on selling assets to cover their obligations discover that there are no buyers at any reasonable price. Even if your personal deposits are nominally protected by insurance, the systems you rely on to get to that money can stutter, slow down, or quietly time out when everyone is trying to move at once. The people who made it through 2008 in better shape than their neighbors had something in common. They did not rely on a single institution for everything. Their savings were split between more than one bank. Their investments were not all piled into one asset class or one country. They owned businesses and skills that could generate cash even when formal credit was scarce. Some had fixed-rate mortgages instead of adjustable ones, which meant their housing costs didn't suddenly explode when interest rates moved. They didn't build their entire life on the assumption that cheap leverage would always be there. Here the pattern deepens. In the 1930s, we saw that control mattered more than promises. In 2008, we see that concentration can be just as deadly as pure trust. It is not only about what you own. It is about how many layers of permission and how many points of failure stand between you and the ability to use it when the system is under stress. Now let's look at an event that added a new, more disturbing twist. Cyprus in 2013. For years, Cypriot banks attracted deposits from abroad with high interest rates and the promise of a stable home inside the European Union. Many depositors believed they had found a sweet spot, generous returns with a European safety net behind them. The numbers on their statements grew steadily, and nothing about their daily life suggested that anything was wrong. When the crisis hit, the problem was not just that the banks had lost money. The problem was that their losses were so large that traditional bailouts would effectively force taxpayers in other countries to rescue foreign depositors. The solution that policymakers chose introduced a phrase most people had never heard before: bail-in. Instead of bringing in new money from outside to save the banks, the money would be created by taking a slice of large deposits inside the banks themselves. Over a few tense days, the rules around those balances were rewritten. Depositors above certain thresholds woke up to find that a portion of their savings simply no longer existed. It had been converted into equity or written off entirely as part of the restructuring. Withdrawal limits were imposed. Capital controls restricted how much money could leave the country. Technically, depositors still had accounts. In practice, they had been drafted to plug a hole they did not make. Once again, the people who came through in better shape were not necessarily the ones who started with the most. They were the ones whose wealth and livelihood were not trapped entirely inside the affected institutions. Some had diversified across different countries and banks. Some had meaningful assets outside the financial system, businesses, properties, or portable stores of value that could be used or moved even under capital controls. Others had kept their operating balances low in the high-yield banks and stored the rest elsewhere. Here the pattern sharpens into something very clear. When the rules change overnight, the difference between your money and your legal claim in a resolution process becomes enormous. What survives is not the biggest number on a single screen. What survives is the part of your life that cannot be quietly redefined by a law passed at midnight or a policy memo written in a closed room. If you step back from these three stories and look at them side by side, you don't see a single magical asset that wins every time. You see three recurring forces that decide who walks away whole and who does not. The first is control versus promises. The second is diversification versus concentration. The third is productivity versus pure abstraction. Control means this: the fewer middlemen stand between you and your resources. The harder it is for someone else's failure to lock you out. A bank deposit is a claim on someone else's balance sheet. Cash in your hand, food in your pantry, tools in your shed, or a piece of land you can work are things you do not need permission to use. Even within the financial system, some forms of ownership give you more direct control than others. Diversification means not letting any single point of failure decide your fate. That applies to banks, to currencies, to countries, and to income streams. If all your savings, all your debt, and all your cash flow depend on one institution or one government staying calm and generous, you are accepting more risk than you think. People who spread those dependencies out discover that when one door slams shut, another one is still open. Productivity is the most overlooked force of all. Purely financial assets, especially those loaded with leverage, are fragile in crises because their value depends on confidence. Productive assets, a business that meets basic needs, land that produces food, skills that can solve pressing problems, tend to keep some of their power even when confidence evaporates. They may suffer, but they rarely go to zero, and they often recover faster when the dust settles. So how do you turn these principles into something you can actually act on? If you are not a billionaire, not a multinational corporation, just a person trying to protect your family, the answer is not to run to extremes, cash out everything, or disappear into the woods. The answer is to build 3 layers of protection that work together. Each layer is simple on its own. Together, they shift you quietly from the side of pure trust to the side of real options. The first layer is liquidity you truly control. That means having a buffer of money you can reach even if your main bank has technical issues or quietly limits withdrawals for a few days. For some people, that is as simple as keeping a modest amount of physical cash in a safe place at home. For others, it might mean a second checking account at a different bank that you do not touch in normal times. The point is not to hoard cash under a mattress. The point is to avoid the most dangerous number in a crisis, 0. How large this buffer should be depends on your life. If you live paycheck to paycheck, even a few days of expenses in reachable form changes your options dramatically. If you run a small business, your buffer might need to cover 1 or 2 payrolls. There is no one right number for everyone, but there is one wrong number that shows up in almost every painful story from past crises, having everything inside a single institution that you cannot open when you need it most. The second layer is spreading your exposure so no single failure can take you down. Diversification is one of the most abused words in finance, but in the context of bank failures, it has a very concrete meaning. It means not keeping all your savings in one bank, not keeping all your assets in one country, and not relying on a single type of account or platform to pay your bills and move your money. It also means being thoughtful about how your debts are structured. For an individual, this might look like having a primary bank for everyday transactions and a secondary bank, possibly in a different region or with a different risk profile. For savings, it might mean holding some assets outside the traditional banking system altogether. Depending on your laws and your risk tolerance, it could mean preferring fixed-rate debt over floating-rate debt, so that a sudden spike in interest rates cannot instantly destroy your budget. None of these steps are exotic or reserved for the rich. They are simply ways of not betting everything on one roll of the dice. For a small business, diversification might include having more than one payment processor, more than one source of short-term credit, and written plans for how to operate if one of those pipes suddenly closes. It might mean negotiating longer payment terms with suppliers so you have breathing room, or keeping a portion of your working capital outside the institutions most likely to suffer in a crisis. Again, these are not secret tricks. They are boring, unglamorous decisions that quietly determine who has to beg for mercy when conditions change. The third layer is building productive assets and skills that soften the blow of any financial shock. This does not mean quitting your job to start a farm overnight, or buying a warehouse full of generators and canned food. It means paying attention to the part of your life that actually creates value, not just the part that stores it. It also means asking yourself what you would have to offer if your usual channels of income and credit disappeared for a while. Sometimes a productive asset is literally physical, tools that let you repair things, a small workshop that can produce something people need, or a rental property that generates income even in rough times. Sometimes it is less tangible, expertise that is still in demand during crises, a side business you can scale up when your main industry is suffering, or a network of people you can trade services with. In every historical crisis, the people who had something the community needed were in a stronger position than those who only had paper claims on distant institutions. Building this layer takes time, And that is exactly why it belongs in your checklist now, not later. You can open a second bank account in an afternoon. You can move some cash into a safe place over a few weeks. But you cannot, in a weekend, create a resilient skill set and a small web of productive assets that carry you through a storm. That part of the plan is built slowly, with small consistent steps, long before the headlines turn red. If you look back at the last century of banking crises through this three-layer lens, the stories start to change. They stop being tales of pure luck and start looking like consequences of structure. People who had no buffer of controlled liquidity, who put everything into one institution, and who had no productive backup were always at the mercy of decisions made far away. People who quietly built those three layers had something that does not show up on a balance sheet: room to maneuver. Bank failures will always feel like freak accidents when you are living through them. The announcement comes suddenly. The doors close suddenly. The rules change suddenly. But from the perspective of history, they are recurring storms along the same coast. You may not know the exact day or the exact shape of the next wave. You do know that it will come in some form, somewhere. Your job is not to predict the next headline before anyone else. Your job is to decide whether you want to be standing knee-deep in the water when it hits, or already on slightly higher ground. A small buffer of money you control, a deliberate spread of risk across institutions, and a slow-built base of productive skills and assets will not turn you into a billionaire. They will do something more important. They will make you much harder to knock over. In the next videos, we'll look at specific historical assets that survived more than one banking crisis, and what their modern equivalents might be for someone with a normal income. If you want to turn vague anxiety into a concrete plan, consider subscribing so you don't miss those breakdowns. And if you're willing to share, tell me in the comments which of the three layers you already have in your life, and which one needs the most work. That answer may be the start of your own survival plan.